Internal controls are enforced mechanisms or actions that operationalize policies and procedures to actively mitigate specific risks. Accordingly, controls are an enforced mechanism or actions and not just theoretical concepts. Operationalize policies and procedures or put them into actions. Actively mitigate specific risk or reduce the likelihood and impact of potential threats to an organization's objectives. Controls are called internal because they are designed, implemented, and maintained by the organization itself from within. They are not imposed by an external body, like an auditor or regulator, but rather are integrated into the company's own operations, processes, and culture to achieve its objectives. Policies and procedures are not themselves internal controls. They create and guide controls. Here's the breakdown. Policies are the rules or set of requirements. It says what must be done. Example, all purchases greater than $5,000 require 3 competitive bids. Procedures are the instructions, which deals with detailed implementation, or else it says how to do it. Example, step 1, request bids from 3 vendors. Step 2, document bids in the system. Controls are the safeguards. They are either protective or corrective or preventive measures. They are actual mechanisms that enforce policies or procedures. Example, system blocks purchases greater than $5,000 without bid documentation. A policy without enforcement isn't a control. A procedure without risk mitigation isn't a control. Bank reconciliations must be done monthly. It's a policy. How to perform the reconciliation? It's a procedure. The actual reconciliation process and supervisor review that catches discrepancies is a control. You have to ask the question of, does this actively prevent, detect, correct a specific risk? If yes, it's a control. If no, it's just a policy or procedure. The primary objectives of internal control are to provide operational effectiveness and efficiency, which ensures smooth business process within minimal waste. Example, controls over inventory management prevent stockouts or overstocking. Reliable financial reporting. This guarantees accuracy and compliance in financial statements. Example, monthly reconciliations detect accounting errors. Compliance with laws and regulations, which prevents violations of legal regulatory requirements. Example, controls ensure tax filing adhere to IRS rules. Secondary objectives. Asset safeguarding. Example, access control to prevent theft. Risk mitigation. Example, fraud detection mechanisms. Strategic alignment. Example, budget tied to organizational goals. Process is a series of steps to complete a task. Example, purchasing inventory. Internal control is a safeguard embedded in the process to reduce the risk. Example, three-way matching of invoices before payment. Safeguard means a protective measure or mechanism designed to prevent or correct or detect risk, errors, fraud, or unauthorized activities. When does the process become a control? A process or part of it is a control only if it addresses a specific risk. Example: payroll processing is a process. Control within the process or the controls within the payroll processing. Approval of timesheets, which prevents false hours. Segregation of duties. HR enters data, finance approves payments. Automated tax calculation, which reduces errors. Process without control. If a process lacks risk mitigation steps, it's just a workflow, not a control. Example: a company lets anyone approve expenses without checks. There is no any control exists. It's just a flawed process. I hope this helped you to understand the nature of internal controls and how they are related with processes, procedures, and policies. See you in the next video.